Hello, Jens.
Hello, Theo. How are
Can you
you?
hear me well? I'm
Uh,
very well. Thank you. How about you?
yes, 1 second. I just have to uh, reduce the volume a little.
Okay.
So I just saw that probably I am missing one important. There we go. Perfect. One important aspect we will cover today when talking about the Fed.
Only one. That's good.
Only one. So nothing else matters.
Okay.
So, yeah, what do you say about the Fed? What's your opinion? What can we make out of this?
Um, to be honest, it was very tricky yesterday. Not yesterday, 2 days ago, actually, when they uh, increased the interest rates, but the US dollar totally didn't move upwards. And only yesterday, after the European Central Bank event, then the dollar took a directional move. But beside that, it's really it's on the edge. That's what I believe. It's on the edge. At some point, it has to also pause that rate hikes. So we see when it's going to be that. Yeah.
Okay, so well, I think the Fed itself, it was a disappointment. No, like he didn't say
Yeah.
anything. That was really like, okay, they delivered as expected. And what's even funnier, to be honest, when you carefully read or listen to the ECB
Yeah.
statement and the comment, it's like they had a call before and they said, okay, we say this and you say exactly the same, and then let's see what happens.
Yeah. Yeah.
Data
That,
dependency. That was yeah. Really, it's data dependent. Didn't know that.
yeah. Yeah. It start feels like it's a joke.
Yeah, it's a
Something like that.
simulation. It's a
Yeah.
simulation. We are living in a matrix.
Yeah. What to say? All
So,
right. So I wish you the best luck.
yeah, let's
Moving
hope the
forward.
best.
Yeah.
Um,
Thanks so much and have a lovely weekend.
so I can already share my screen. No, I just
Yes.
saw it,
Yes.
and there's okay, perfect. Then let's do this. That's perfect. So let me just type in hello into the chat box, and Theo, have a nice weekend. Enjoy
You too,
yourself.
Jens. Thank you so much. See you.
Talk to you next week. See you. Bye bye. So, hello, and I welcome you to today's Trading Spotlight webinar. What is it? It's the 28th of July. It's Friday, yes. And we want to talk, it's not really let's trade the Fed, but it's more likely what to make out of the Fed and the policy decision they delivered. And well, I think it's kind of interesting because we just received new data. It's around 35 minutes ago. And it was the PCE core deflator. And as you may know, this is the favored inflation measurement tool from the Fed. So, and it came in below expectations. And I think at the lowest level, let me just check it out. Oh, I'm sorry. This is a little slows in June. It was the lowest since September 2021. So we have this now, and now we go back. And so cooling inflation, let's see how the data comes in. Next week, we have a very, very interesting news event with the non-farm payrolls next Friday. It's going to be very interesting, I think, because if numbers disappoint, that points to a slowdown, no further rate hikes, probably even more likely cuts in the first half, even though, and this is the thing, this is the backdoor the Fed has, or open for itself. Powell said that the Fed does not expect inflation to cool down significantly till 2025. So, and this is very interesting. If you now look at how markets behaved on that, especially gold, but also equities. And yesterday was very interesting, to be honest. I think yesterday's reaction, especially into the afternoon, early evening, at least your German time, that was the drop most likely resulted out of out of the expectation from market participants in terms of a more restrictive stance from the Bank of Japan. That's probably also something to take into account. Probably, first of all, before we continue talking, we will jump into the charts. That's probably even better and take it from there. So first of all, let me make sure that we are all on the same page. We are talking about leverage products here. So CFDs, FX, these are leverage products. They are not suitable for all investors. And before you start trading, please make sure that you understand all risks involved when taking positions here. In addition to that, please don't take anything I present to you right now as financial advice. It's not, it's purely educational, purely informational. If we draw any trading plans or setups, it's again for purely educational purposes. Please be aware that if you say, well, this is a great idea, I want to take the trade, that you take full responsibility when trading. And again, before you start with a demo, download a demo and read carefully through the risk disclaimer and all characteristics involved when trading CFD FX products. I don't think we need to further introduce Admirals as a broker. You're probably all aware of the fully regulated broker you're confronted with here, with a very, very competitive offering when it comes to FX CFD trading, but also when it comes to physical stocks. So fully regulated around the globe offices, which is to some extent very important, I think. That's probably something which is noteworthy. When I was much younger, let's say 20 years ago, I started my career in the financial sector as a trainee, as a bank clerk. And what was very interesting was we had a kind of, let's say, international audience. And you just can see the difference when talking to someone in your native language and talking to someone whose native language was different from German in this case, because there was a complete, it's not complete, but there was a different level of trust. And this is something which is very important when talking to admirals here. So we're offices around the globe. That means you have a chance to talk to someone in your native language in the client customer support. So that's probably something noteworthy and probably you weren't aware of. And take a chance. Just reach out to them. If you have any questions, feel free to contact admirals directly. Before we go into the charts, this is a look at the Fed Watch tool. So I usually screenshot this and we will go through the website respectively. I will post the link here in a few minutes so that you can check it out yourself. It's giving us an overview of what the market is expecting right now in terms of the further monetary policy from the Fed till December. So right now you can see here that with the likelihood, these two columns, 9% and 63.5, are summing up to, or are adding up to over 70%. That means that more than 70% of market participants say, well, we think that's it. In terms of rate hikes this year, there's another 27% here, as you can see, saying we will see a further rate hike. Most likely the guys here seeing another 50 basis points. This is more like a hedge. What do I mean by that? So we are looking here at the futures market and options market, and what they do, you probably have heard about Greeks, and they extract, especially when looking at the so-called Greeks, you'll know probably delta, you probably know, I have something heard about gamma, and there's also rho, for example, which is covering the interest, and here the interest level, which is then adding to the overall price you have to pay for an option. And they extract this from different time frames, and then they build this model here to have an overview of what's the expectation of market participants in terms of rates to be at a certain point in future. So this is where these columns come from. And as you can see here, so 50 basis points higher, probably there's some market participants now saying, well, we are hedging the risk of further rate hikes to come because inflation probably won't cool down. What could be the reason? Look at, for example, crude oil. We just bottomed out. Let's probably jump into the chart and have a look here. I don't have crude open, by the way. Let me just probably take the, I have it open. Certainly I have it open. There we go. So this is crude oil. As you can see, we are heading for the yearly highs, the region around the yearly highs. Let's see if we break higher. But from June onwards, you can see there's a clear uptrend forming. Very solid, very straight, very clean. And so this uptrend here is something to keep in mind, because let's probably do something differently. Go over here to the US PCE. 1 second, by the way. You're not seeing my screen? You're not seeing my screen? No? What do you mean? You don't see the screen right now? So you're seeing US PCE inflation? It's all right. Okay. Okay, then it seems to be a local problem. So you can see everything. Everything's fine. That's good. Okay. I will share here the Fed Watch tool, by the way. So I have the tab open. Call this Fed Watch tool. Fed Watch tool. And let me, by the way, check out here. Oh yeah. Okay, going back to trading economics. So US PCE inflation slows in June. We, by the way, could also pull this up at admirals.com. That's probably also a very good source in terms of the Forex calendar. So you go to analytics here, Forex calendar, and here, Europe, and then you can use a filter. Let's go to the United States. I usually check all boxes of the currencies I'm interested in. And then I apply the filter. It's not hot. Let me just see. Has it been? Yes, it's been hot. So we can filter even more. So then we can say impact, 3 red dots, very hot. Let's just do it that way. And there you can see core PCE price index month on month coming in as expected, 0.2. But still, especially year on year, considering that, at the lowest level, as you can see here, since September 2021. Again, it's a very interesting number. It's obviously has something to do with inflation. Inflation has cooled down, as we have seen CPI numbers. And it's, as you can see here, the annual rate. It's the Federal Reserve's preferred gauge to measure inflation. So they are not looking at the CPIs, but they are looking here at the PCE in this case. And so that being said, means if this is cooling down, it makes it more likely that the Fed won't hike rates any further. Let me just, by the way, update this chart. Let me just see, probably changed. I haven't updated it yet. So this is September. Now let's go to the, well, in fact, it decreased a little. That's even more interesting, to be honest, for whatever reason. Okay. However, at least I interpret it in this way. They'll probably put it that way. And you still see it. It hasn't dramatically changed. It's just a small tick higher, lower. Depends a little on how you price the option. So don't overthink this or overweight this. Any changes here, but still, we see that the majority of market participants is expecting the Fed not to follow through with further rate hikes in the months to come. In fact, if you continue going into the future here, and we go, for example, to March 2024, you can see this changed. This is surprising. I haven't seen this. So nearly 50% here, a little lower than that, a little over 45% say, yes, we will see a rate cut. But as you can see here, market participants expect rates to be 525, 550 in March. Let's see what June delivers. Yes, and in June, then the majority shifts. Then we have 50% expecting rates to be 50 basis points lower than they are today. So in the first half, market participants still think, in the majority here, that the Fed will cut rates. But as you can see, it's not an aggressive rate cut cycle the market is expecting, as we probably have seen, especially in March. And the reason for that, now coming back to the chart and WTI here in this case, the reason for that, I think, is because the developments in the CPI especially, and if we are not looking at core inflation, but we are looking at commodity prices and how they affected it, the main driver, let's go now back to trading economics and then here to the United States and the inflation rate, to just have it right here. So July, respectively June 2022, numbers which were published in July 1 year ago around the inflation, they came in at 9.1%. And now you can see there's a clear decrease, trend lower, 3% now around 2 weeks ago. And you can see this went hand in hand with the, to some extent, top out. There was this extreme spike higher after Russia invaded the Ukraine. And then you saw the lower high here, the spike higher, corresponding with the highs in June. And then from there, we saw a steady downtrend delivering. And this gap up here, this bounce, that was an OP meeting that was in April around. As I think the production cut back then had mainly to do with seasonal reasons, in fact. However, so from there, we now bottomed out. And this trend lower here corresponds with the trend lower in inflation, which brings us to the idea we are not talking about inflation going back to something like 10%, at least not for now, given the current circumstances. But if WTI continues to rise, and currently prices here of WTI started to push to the highest levels since April, there is a serious chance, let's say, that we are probably headed back towards 4%, 3.5, probably 4%, depending a little on what the overall numbers come in for other goods which are considered in this basket. But all in all, chances seem to be realistic, let's say, that there is a push higher in inflation due to the developments in oil, which makes it likely that what the Fed just delivered in terms of rate hikes is not yet the end, which is then probably showing us why the market is still, with some likelihood here, expecting that the Fed will continue to hike rates. It depends a little on how inflation develops now, which is now bringing us to the point that in the second half of no, it's the first 2 weeks from now, 1.5. So next week is the non-farm payrolls, and then the week after we have the inflation numbers on Wednesday. When numbers here come in, this is a highly anticipated event, I think, and it's very, very interesting because in this context here, if the numbers come in hotter than expected, this could finally cause a sharper pull in equities, which is not corresponding naturally with what we've seen yesterday. Therefore, let's go here to the NASDAQ, for example. As you can see, so yesterday, not really sure if we can see that. So you can probably see here. So this is a NASDAQ on a daily time frame. Let me take out these numbers here. So solid uptrend. We saw a pull in that was last week on Wednesday, short technical reaction, let's say. There was no trigger. And then you said probably yesterday, we came in quite strong on the Fed. But as you can see here on a 5-minute chart, we came in quite strong after the Fed on Wednesday in the evening, and then we sold off sharply. And the question is here, why is that? Where does this come from? Was it like, hey, market participants really expect the Fed to probably hike one more time? Or it's like, what can you make out of this? Where does it come from? I think it has nothing to do with the Fed. I think, first of all, it's a natural corrective move. You can expect after we went a little vertical, I wouldn't say, but now straight upward. So the technical reaction seems valid here. So some selling pressure coming in, but not just that the selling pressure comes in. We have also taken into account there's potentially another reason. And if you carefully see or watch the chart here, you can see that there was another quite volatile event overnight taking place here. And if you look what happened that time, you will find out it was when the BOJ had her press conference tonight. And so now you might wonder, okay, what has this to do with this drop here? Well, you probably have heard that the Bank of Japan is not running a quantitative easing, but a quantitative qualitative easing, and not a QE, but a QQE. And they're targeting the yield curve, and they try to control the yield curve, especially around 10-year Japanese government, 10-year Japanese government bonds. And what they try to achieve is they want to make sure that 10-year Japanese government bonds and their yield is tagged to 0%, and they let it fluctuate within a band, in this case of 50 basis points to the upside, respectively to the downside. And I could imagine here, there were rumors spreading that potentially the Bank of Japan is willing to expand this band even further, a little, or be more flexible, let's say, in terms of buying bonds here within this band, which is very similar to a rate hike, even though there was no rate hike announced, and they have still minus 0.1% interest rate levels and so on and so forth. So very, very expensive, even though they have high, relatively high levels of inflation. But still, that caused this drop. You might now wonder why, because Bank of Japan, why should this affect global financial markets, especially the tech sector in the US? I think the reason is quite straightforward, and we know this already. You've probably heard about the so-called carry trade. And if you finance trades in JPY, so you're borrowing JPY very cheaply, and then you invest it in a high yield in currency, or in into an asset class which is highly or more attractive from a yield perspective. And if you then see that your vehicle to finance such bets is getting more expensive, because now borrowing JPY is getting more expensive if they hike rates, or if at least there's some spikes higher into longer term rates, well, you see a natural tendency to market participants then say, okay, I reduce these bets because they get too expensive. I'm, let's say, fully leveraged, whatever. So I have to reduce the size into these trades, which is then probably the reason why we get to see this pressure. And again, this, my opinion, corresponds really well to this elevated volatility we've seen around the BOJ overnight, which we usually don't get to see in terms of the NASDAQ. The same is true for the DAX and S&P 500 and so on and so forth, but we take the NASDAQ. So now, but you can see now, well, we didn't break through on the downside, but instead it seems as well, it came in as expected. And in fact, it did. I haven't prepared it yet, but in the morning, there was some tweets from a very well-informed channel, Live Squawk. I highly recommend following these guys on Twitter. And they tweeted this out, what the BOJ delivered, and they came in as expected. They said, yes, we are more flexible and willing to leave 10-year Japanese government bonds and yields spike up to 1%. But still, it was nothing which is really causing some kind of deleveraging or something like a JPYs being bought back, and these carry trades, these bets are being reduced or something like that. So long thing short, it seems as if, well, the market right now is anticipating to some extent a more dovish stance. This is true for the Fed. It's also maybe true for the ECB. In this case, it probably makes sense to have a look at the DAX, which is currently aiming for new all-time highs and just made new all-time highs, if I'm not mistaken. So slightly above that. So very bullish. Already anticipated this to some extent yesterday. That was a little unfortunate because it was difficult to trade, in my opinion. We saw the break above a very significant resistance here around 16,200, 230 already before the ECB took over at 2:15 p.m. German time, if I'm not mistaken. And we drove higher from there. So the market is anticipating a more dovish stance. I have to say, especially coming back to the Fed and the NASDAQ, I think there's now a risk involved that most of this dovish stance and expectation that the Fed is done hiking rates. And by the way, I just saw it here in the chat box. Someone is saying, hi, everybody. I'm not thinking no more on Fed rate hikes as the raise and increase rate stock market gets stronger. So it does simply not make sense, though it can make sense on a comparison with other currencies. So, oh, you mean no? I see. It's double negation. So I'm not thinking no more Fed rate. That means you think there's more rate hikes. That's interesting. That's an interesting take. I think, well, I take the other side of the trade. I would say no. I would say they are done because as you can see, I mean, I see the point, which is a valid one, by the way. So this is right now where it makes perfect sense, right? You see equities rising. You see still to some extent strong employment situation in the US. You see solid numbers when it comes to the GDP. GDP growth rate was yesterday released 2.4%, 1.8 expected, so better than expected for the second quarter. It was the first release of this data set. Let's see how things come in at a second estimate end of next month, and then the final release at the end of September. But numbers still look good. Still, I have to say, longer term, and especially given the tensions you can also see in the retail sector, big retailers like Walmart, Target, for example, giving them numbers, I'm kind of like, I would say, well, looking ahead, and especially how things are developing in the US with the next presidential election, which is taking place, by the way, 2024 in November. The Democrats right now running into lots of headlines in terms of the Biden administration and the support for the Ukrainian government, and questions and the tensions and the big division between the left and the right, respectively, Republicans and Democrats, which has always been already been seen at the last presidential election. I could imagine that now the White House potentially is aiming to somehow get a more, let's say, economy focused and positive stance from the Fed, trying to convince them to probably don't be too restrictive from here after especially inflation came in. That being said, that they're not that let's say that there's some kind of, like, let's say, a deal behind closed doors. That's probably a good way to put it. So I'm really, I just don't think that right now, especially with all the tensions in the banking sector we've seen in the regional banking sector. I mean, not sure if this really was a crisis, but the tensions are there, and I think you shouldn't hike too much. I think you brought inflation back under control. Probably there's some skepticism arising once there's some upticks, which is most likely due to oil prices continue to push higher here. But I don't think that more hikes are really that productive, but I think they are more counterproductive. And by the way, I just have to write down something here in preparation of my US equities trading. So I have several stocks on my radar for today, especially Roku. I think is a very interesting one after the numbers yesterday, and not just from an intraday trading perspective, but in fact I will try to play it for a swing if it can hold above 75, 74, 75, something like that. Intel also with numbers. I have to write down some numbers here, which I will work with once I end the webinar. And let me just here. And then there's one final play in NFP. NFP is disappointed on revenue, gapping aggressively lower, even though now coming in a little stronger. US equities. So the question from Kareem is, what's your favorite asset to trade? It's equities. US equities I'm focusing on. One sec. 903. Okay. So now I'm well prepared. Let's see how things play out. Coming back now to the presentation. So that's my take, in fact. And let's probably go a little through what the Fed delivered. I prepared it here from CNBC. So Fed approves hike that takes interest rates to highest level in more than 22 years. And what's even more interesting, I think, is here. This is this bullet point from Fed Chairman Powell. So Powell said the central bank will make data-driven decisions on a meeting-by-meeting basis. That's very interesting because it's it's the same rhetoric being used from the ECB at her meeting yesterday. And that's why we are now in an environment. I think this is the main reason why we do this. So lots of speculation now. Is the Fed done hiking rates? We don't know. Well, taking above, and so on and so forth. How can we use this in our trading? I think this is the main question. So using this fundamental idea, and I think it's important to point this out. We make all this and all these thoughts around this and what the Fed delivered to get a better picture of what the market is currently seeing, and what the market is expecting, looking carefully at what the Fed delivered. So we are at a point right now where there's a question: further rate hikes or no? I think no. I think we are done. On the other hand, as we've just seen here, Karim, for example, says, well, probably there's more rate hikes to come. However, at the end of the day, it's what do we make out of this if new data comes in? Like next week, non-farm payrolls, and we will look at this, and we will take this here next week as a, let's say, we will take this as a fundament, let's say, or as part of our game plan for potential assets we plan to trade based on the non-farm payrolls. So the question is, like, okay, if it's data dependent, what does it mean? Well, it means nothing more than now we get good news. The Fed is likely to hike more or keep rates at least at that elevated level. We get soft economic data, well, more likely to keep rates or cut them, but no further rate hikes. So, and then based on that, we build our place. We say, okay, great. That means hiking rates or higher interest rates, most likely not positive for equities. Well, that means, well, most likely if data disappoints, then most likely we will get to see we get to see further push on the upside. That's at least what we think what will happen. While if the Fed, further rate hikes, good. I'm sorry, I think I put it the wrong way around. So good news, hiking rates higher than expected, rates for longer. That's usually bad for equities, and that's why we see most likely a drop on the downside that way around. While soft data is better for stocks due to the fact that the Fed won't likely continue hiking rates, respectively, cut rates earlier. The question now is, when looking at, for example, the Nasdaq here in this regard, the question is how much of this idea is already priced in, and I think there's a lot already priced in. When it comes to a more dovish stance, let's say, from the Fed. That means right now I'm in a mode where I say, based on the quite solid reaction we have seen so far in equities, I would say, okay, very solid reaction, quite strong from bulls. So far, so they continue to stay in control, let's say. And now the thing is, I could imagine, given the low levels of volatility and summer and vacation time, that we probably continue to trade within the range in the upcoming days. The next potential macro trigger is then to be found here around the non-farm payrolls next week, and then the inflation data the week after. And if we get to see strong job numbers, we will see that next time live here at the next event, or the week after, inflation, which sees a tick up. I think we have a good chance to push lower. And in addition to that, I'm not really sure whether we have such a good chance to really see a strong push higher here on the upside if data disappoints in terms of employment situation, or we get a soft inflation print like 2.8 or 2.7, something like that, because most of this is most likely priced in. So I'd fade breakouts on the upside if we get to see a bullish push. I'm not just shorting into it. I mean, would wait for a clear sign that this is a potential fake out. While on the other hand, I'd trade the short once we break below this range here, and could imagine to see a pull-in, which will probably bring us down to here, this trend line, probably down to probably 15,000, probably a little lower than that, 14,700, 800, something like that. That's probably, yeah, that's how I would play right now, the Nasdaq, for example. What I think is very interesting is what we've seen in gold. Gold hasn't yet broken out above 1,980, 1,985. That's very interesting, because usually would say, okay, well, why is it interesting? I mean, at the end, I would say, well, the Fed didn't deliver anything in terms of rate cuts. I continue to be very bullish on gold longer terms, like 5 years from now, because there will be a rate cut cycle, let's say, and this is usually very bullish. Looking last 20, 25 years, you will see this if you do your own research here in this regard. Even though yesterday, especially on the GDP data here, we saw a bounce lower, even though I have to say, well, I'm not really buying it. It's kind of a like, the Fed won't cut rates quite soon from here, because the GDP data came in stronger than expected. Because the thing is, this would have caused also a drop in equities, which we have seen later that day, yes, but there was no reaction at all in the Nasdaq, for example. So if there was really like, that was here around, that was around here, that area. So you can see it, you can't really see it, to be honest. So it's not just there, it's not there. So, and this is definitely something which we should keep an eye on, let's say. This looks just, how can I say, I mean, it looks like a probably good reason to sell gold, push it to lower levels and avoid a break higher for whatever reason, than a data related event we've seen there. So I continue to be bullish on gold, but still I don't want to be long below 1,985, especially here. The macro events like the non-farm payrolls, but also the inflation numbers will be crucial. So numbers coming in cooler than expected, lower than expected. NFPs next week, probably we get already an anticipation after the ADP data release on Wednesday. And especially inflation coming in cooler than expected. I think these are both two good reasons to be or to think that we are about to head significantly higher, break above 985. If we hold, then that we are then good to go for the next weeks up to the all-time highs. As long as we hold below, I don't want to be I'm not interested in gold, especially not from the long side where my overall bias can be found. So that's probably something to keep an eye on when we look at gold. Let me just check out here. Okay, I have to read through this. Let me just see the question. That's already something to, yeah, well, I'm not sure. It's like, I'm not sure if we can put it that way. I mean, yes, the Fed can manage the inflation to some extent, and if the Fed hikes rates, then usually you expect inflation to cool down, because it's more, let's say, attractive to keep money in your bank account and get paid for keeping money in your bank account, for getting interest on your money. Beside of that, companies are not as likely to take out loans to invest, since it's more expensive and they have to be more productive, let's say, to repay their debt. And it's biting into their margins. But I have to say, well, decreasing inflation is also you're capable of letting inflation coming down if you just avoid spending more money from a fiscal perspective, like a government. So and this is exactly the reason for the push higher in inflation. It was due to fiscal spending financed with liquidity being provided from central banks around the COVID pandemic. And that was the driver for inflation. So the main reason for inflation is not be found in higher productivity or something like that. So that's definitely something to keep an eye on. And if you take this into account, then you will see that solely hiking rates won't bring inflation down. Okay, I'm not sure if I get the rest correctly. I'm sorry. So yeah, well, probably I have to think about this, and then we take it. I'll take the question to the next event and this regard, because I'm not really getting the question. I'm sorry. So that's it on gold. Probably let's have an eye. Let's keep an eye here on dollar JPY. I haven't looked at it. That's perfect. In fact, from a trading perspective, that's a perfect price action. In fact, so you can see here that was the line in the sand around the 200 SMA in this regard. What I don't really like is that there's a slope to the downside. So this is probably something to be a little aware of. But as you can see here, we flushed lower here yesterday, respectively, in the morning around the BOJ, and now are aggressively bought back. So that's clear bias stepping in here in dollar JPY, which means it seems, even if there's a more hawkish stance from the Fed, market participants expect the rates differential between US and JPY staying wide and more attractive for US dollar long, which means like the carry trade is still on. And having seen this now with this strong reaction, I'd consider this to be interesting from a longer term perspective for long play, in fact. And especially if we break above 140, 180, yeah, 142, let's see whether we can break higher here, because then I think we are potentially headed higher. We're potentially headed higher up to 144, 145, and probably even higher than that, and up to 150 in the months to come. And this is especially an interesting trade since there's a positive yield differential. So this is a classic carry trade in addition to the expectation of the JPY continuing to devalue. Also very interesting and to keep an eye on, especially if numbers, and then we have the same thing. If you have data coming in better than expected and the Fed continuing to not hike rates, but keep them at an elevated level for longer, this is making this trade even more attractive, and meaning that this should act as kind of a bullish trigger here on the upside. While disappointing employment data or cooling inflation in this regard is making bounces more likely, even though I would say the picture technically darkens solely if we break this trend line, which we just formed here. So probably we can make it a little steeper. But all in all, as long as this trend line can be held, and we can hold here above 138, around 138, the overall outlook longer term for dollar JPY stays bullish and likely to see a deep push back above 140, I would say. And so yeah, well, that's it, in fact. Let me just keep an eye here on where we stand. So equities come in better than expected. So tech stocks bought back, as you can see here, bullishness. So we are about to make back all the losses from yesterday into the afternoon. Nothing more to add. So overall, be really careful in terms of short engagements. I've seen some on social media, some people saying, okay, that's the top. I'm now getting heavily short, even though I cannot fully understand that, like in Meta, for example, after earnings, like saying, hey, well, we are so extended here, most likely we're done now on the upside. Even though I have to say, while I agree that we have less potential on the upside, I'd be really careful in the current environment, and given low volatility, an environment with the VIX below 20 points, to be aggressively short. So be really, really careful with that. So yeah, and that's it. I hope you got something out of this webinar. And all the best. Happy trading. Talk to you again next week. Talking then the non-farm payrolls, potentially live trading them. Let's see if something provides here for us to trade. And have a nice weekend. Enjoy yourself. Talk to you again next week on Friday. I really look forward to it. See you.